a todos, bienvenidos a un nuevo podcast de Chasing Alpha. Estamos con Santiago y Oscar, muy contentos. Tenemos con nosotros el día de hoy a Jim Riggio. Jim hizo una de mis presentaciones favoritas en una reunión que tuvimos de todos los temas macroeconómicos e interpretación de lo que estaba pasando en Estados Unidos. Es un analista macroeconómico, pero tiene muchas más facetas. Jim, welcome to Guatemala. We're really happy to have you here. And we're really looking forward to your presentation in Chasing Alpha. And tell us a little bit about yourself.
I went to school actually as an engineer. I did both my undergraduate and my graduate work in computer science. I did a lot of technology work. Spent almost the first decade of my career at IBM, back when IBM was IBM. The second decade, I ended up working mostly for PricewaterhouseCoopers. I rose to a partner level in financial services. I wasn't a tax guy. I wasn't an audit guy. I was a management consultant that focused on technology in the financial services industry. I ended up leaving them in the early 2000s, and I started my own consulting firm. I did a lot of work with smaller investment management companies, and I started my first hedge fund in 2006. Had a great year and a half. Okay. then 2000 came. We ended up recovering after a while. I started my second fund with a couple of ex-Goldman Sachs guys. And what we did is that we generated income through the derivatives markets in the United States using puts and calls on equity indexes and other things. But what we did very differently is that we built our hedges to protect the downside. So this way, when we end up seeing markets that had turmoil and big sell-offs, we did extremely well in being able to protect that capital. That fund actually turned into a 40s Act mutual fund in the United States. To become a mutual fund, it's very different. There's a ton of regulation. And so we used some of it where we became a fund. It's still around. It's called the Easterly Hedged Equity Fund. My partners, that I founded everything, they're still running everything. They've been a 5-star Morningstar fund, and they've outperformed just about everybody in their class. And their class is hedged equity. They're in the equity market, but they're trying to protect the downside. The best example I could give to you would be in 2022, when the S&P was down about 19%. They were down less than 3% because of the way they built those hedges. The thing that really ended up changing for me was that when the pandemic came, I had a colleague who had raised capital for me before, and he said to me, Jim, I don't remember a lot about when I was going for my master's in my MBA, but here are the things that I remember. The U.S. government's printing a ton of money. They're taking on an enormous amount of debt, and nobody's working, so there's nothing coming in on the taxes. So there is going to be a huge challenge, with inflation and other things coming down the road in the next 24 months. And we had seen that. So what we started to end up looking is, what is the single best way to be able to protect against environments like that? And the answer was gold. Right? Gold has been a form of money for 5,000 years. If you take a look at different writings, one of my favorite authors that I'll end up taking a look at is Ray Dalio, who founded Bridgewater, one of the largest funds in the United States, private funds. He wrote a whole bunch of books, but the one that really, really changed the way I ended up thinking was called Principles for Dealing with the Changing World Order. Mm-hmm. And there's a short video online that he does an incredible job. But in the book, he goes back to the Roman Empire and the Chinese dynasties. And he goes through what happens at the end of an empire. And you take a look, he has about 8 different things, in the video. In the book, he'll go through about 23 different areas. But things like this. If you keep spending more money than you take in, and you have all of these expenses that you're paying out for your citizens, eventually your empire will collapse on the weight of itself. Mm-hmm. If you take a look at who dethroned the Romans, mm-hmm. the Romans did. They just spent so much money that they weren't able to end up keeping things going. And you go through other things, whether it be education, financial centers, international conflicts, internal conflicts. This is one of the biggest problems that we've seen in the United States. is that we have the left and the right, and they fight against one another. And over about the last decade or so, politics in the United States has just gotten nastier and nastier and nastier, to the point where they can't do anything constructively. If you take a look at what's happened and the amount of debt that the United States has created over the last decade or so, it's gotten to be unsustainable. And so what ends up happening is that the only right answer would end up being, you need to end up taxing those people who make a lot of money more, and you need to stop giving away so much stuff in different programs. But the problem is that if I ran for office and I said, Santiago, you make a lot of money, I'm going to have to tax you more. You guys that get free stuff, you're going to get less. Vote for me. Okay? Mm-hmm. I'm not going to. And that's the challenge with democracy, that while there's so many different things, the problem is this: we have borrowed so much money in the United States. How many zeros are in $37 trillion? That's what the U.S. debt is. How big is that number?
Yeah, a couple.
I like to say the number so the audience gets how large the number is. Those are $37 million. That's a lot.
So this is the way I always look at it. I say, if I'm afraid of heights and you take me up onto the roof and we're 37 feet above the ground, I'm scared out of my mind. But on the plane, if I was flying at 37,000 feet, I look out, it's too big for the brain to comprehend. So one of the things that I like to end up doing is like, how do we make this more personal for people? So if we did this, if we took the $37 trillion and we divided it by the number of taxpayers, let's make believe this was a loan and we wanted to pay it back. How much do my wife and I, how much do you and your wife have? How much do each of us owe as a household or as a married couple? That's where we're all taxpayers. The answer is over $600,000.
Wow,
that's crazy.
It's absolutely. So when you see things like the United States pays over $1 trillion, okay, per year in interest. In interest. Last year, we now pay more money on the interest on our loans, right, our debts, than we do on defense. We spend more on defense than anybody in the world. It's insane. And the challenge with this level of debt is, how when you guys are running a project and the interest just keeps compounding and how it gets real. Well, this is working great in a project. Well, this is working in the opposite direction in the United States right now. And so what ends up happening is you have the left and the right fighting more. And the challenge is that everybody has become to a point where when you start reading and taking a look at Ray Dalio's checklist for a changing world order, it's like internal conflict, check. Debt getting out of control, check. Spending more. And you kind of take a look at this. And if this was a baseball game, you kind of look at it and saying, we're in the 7th or 8th inning here. What do we do to change this? Or what do investors do to be able to protect themselves?
I think that would be something that I would like to ask you. The U.S. economy, even though with all those the current
challenges,
economic challenges and the environment, it's still the largest economy in the planet, largest capital markets ever.
Yes.
So we discussed the other day the market neutral.
Yes.
I would love for you to explain to our audience why they want to invest in the States.
Okay.
Or because it's a scary scenario, but there are ways to hedge against it, to protect oneself from, the negative consequences of the irresponsible decisions of the politicians.
Exactly. Yeah. We run two separate funds. The first one is the gold one, and what we end up doing is that we generate income. Okay, the best example I could give you is the real estate example. When you buy a piece of real estate, you end up having a bunch of income that coming in. I don't know if you use this here in Guatemala. In the U.S., a lot of first-time home buyers will end up getting in with a program that some people call rent to own, or right? Are you familiar with that?
Yes.
Right. You spend a little bit more money, and then So it might be something like this. Let's say the house is going for $500,000. People move in and they end up having a contract where they can buy it over the next 2 years for $600,000. And some of their rent goes towards that. Now, what happens if they don't buy it?
It's expensive rent.
The expensive rent. The owner just gets to keep it. We use an exact same type of program in the United States where we're collecting this extra money, okay, in case gold goes up. And unlike a contract in real estate, I can change my contract every month. Oh, the contract went up. Let's rewrite another one at a higher price. And so we're constantly collecting money. Like a good landlord, I don't keep all of the money, okay? I buy some insurance. What we end up doing is, as I mentioned before, right, we build hedges on the downside. What this allows me to end up doing is that we use the two functions of bringing in income and asymmetric risk, right? For us quants, okay, us math guys, we love to go really, really deep in it. For everybody else, all it means is we're risking a little to make a lot. If I can risk $1 to make $2, okay, I have a good bet. And so we use those types of things. In the market neutral side, right? So that's the first one where we're using gold as our backstop, as our commodity. In the second one, the level of, I'm going to call it, change or how nervous the markets are, the fear index, okay? It's spiking all over the place now because of what's going on in the US, what's going on in Russia, in the Middle East. And when this ends up happening, you have to, as a hedge fund manager, learn how to take advantage of this volatility. What we end up doing is that we'll sell the volatility, right, as it goes up, but we'll end up always buying insurance underneath. Mm-hmm. And what I love about the way we do our market neutral, different than the way I've seen almost anybody do it, is that we over-insure the downside. So think about this. If you had a $1 million house, but you ended up having $1.5 million in insurance, what's the best thing? Your house burns down and you're like, this is great. So you lose your picture. But what ends up happening in our portfolio? What happens in our portfolio? If you ask me, what's the best possible thing that could happen to our market neutral fund?
Drop.
If we wake up tomorrow morning to Armageddon. Mm-hmm. So, I kind of take a look at, everything that's going on with the political environment in the United States and Donald Trump. For us, he's the gift that just keeps on giving. It's great.
I'm going to explain something to our audience in Spanish because en esta presentación de Jim, todo lo que ustedes van a recibir de ellos de Jim Riggio es masterclass. Lo que él está explicando es cómo funcionan sus fondos. Tiene un fondo donde el subyacente, el activo es oro, y él lo que hace, cuando él habla de hedge es, piensen en un seguro, es cómo protegen su inversión. Entonces, si la inversión baja y ustedes están protegidos, el seguro paga. Y lo que está explicando un poco Jim acá es que él, en uno de los fondos que él tiene, lo que él hace es que sobreasegura la inversión. Así que lo mejor que le puede pasar, como él lo dijo, es que sea Armageddon, que se acaba el mundo y cuanto más volátil y más loca la economía, el fondo va a estar mejor y mejor y mejor. Hay gente, se necesita un conocimiento muy profundo para hacer esto y eso es lo valioso de un fondo, ¿sí? Llegar a aprender y tener la experiencia de Jim, to get to the point where you are. The amount of math, the amount of experience, the amount of bad experiences that might have. Yes, they're untenable. They're a lot. I mean, so that's what I was telling them is the value of investing through a fund. Because if I try to do what you do, I don't have the knowledge. No. It's
what I love to tell, new and younger traders is that I have lost money in new and innovative ways that you haven't even thought about. Okay. My wife is sitting over there. She'll tell you, he lost doing this, he lost doing this. I have a lot of scars on my back.
Let me translate that. Dice, lo que me encantaría decirle a todos ustedes, nuevos brokers en el rubro es traders. Yo he perdido dinero en formas que ustedes todavía no han aprendido, ¿no? Tengo cicatrices por todos lados. Sorry, go ahead.
No, but that's it. It's I think that anybody who's investing right now, I think there's great opportunity, but you also have to be prepared. What if? What if certain things happen with, the tariffs? What if things don't end up settling, in Russia and Ukraine the way? What if, we have these import-export wars? What if, China ends up getting really tough on Taiwan? There are so many knowns that, uncertainties. But then what's really scary is the unknown portions of it. Markets are very fragile. And the reason why I think that they're so fragile is that there's so much algorithmic, computer-based trading. And you have more and more market participants that are going in and using some of these different algorithms or these quant bots, and they don't know what they're doing. And the challenge is that even the big institutions have leveraged what they've done so much. I'll give you a great example. In early August last year, a lot of the big banks, not just in the United States, but around the world, what they would do is that they would borrow money in Japan. Japan bonds were paying close to zero. The bonds in the United States, the government bonds were paying about 5%. So if you could borrow money, at 0%, and put it someplace else and get, 5%, how much do you want to borrow?
Everything.
Everything. Now,
as many times as you can.
And because the banks, because of regulations, they are allowed to leverage themselves a huge amount. They did. When Japan suddenly started to raise rates, and last year the US was starting to lower rates, their profit margin was getting squeezed, and they were losing money on the exchange rate. Mm-hmm. So it was like somebody yelled fire in a crowded theater. And they all tried to get out at the same time.
Boom.
So because of this,
all the triggers.
Because of this one event where, oh shucks, the big banks are going to end up losing a little bit of money, we had the single biggest jump in the fear index in history. Let me explain. The markets end up having something called the fear index, or for you traders, it's called the VIX. And basically what it is, it's those insurance policies, those hedging, those puts and those calls. The more expensive they get, the more they think the market can go up or down. And so when you're fearful that the market's going to move a lot, you end up buying these things. And when you buy them, the cost goes up. Mm-hmm. And so the index is basically the cost of insurance. My wife's from Puerto Rico. She hates when I use the Puerto Rico example, but it's kind of like if we had hurricane insurance in South Florida, and how much would I want to pay for my insurance during non-hurricane season? Nothing. Nothing. How about during hurricane season? Okay, I'll pay a little bit more. How about if there's a Cat 5 hurricane in the middle of the ocean and it's coming, east, towards us?
As much as you can.
Well, you pay a lot more. What happens if the Cat 5 hits Puerto Rico and washes it out to sea? People are lining up with their firstborn child, trading them in because the insurance is so expensive. And so what's happened is that the speed at which that insurance changes has gotten so quick and so fast because there's so many institutions that are doing this, is that we will see more volatility, not less. And so when people end up going in, they have to end up realizing and be prepared for that.
I have just one question for you, Jim. I've always talked with Santiago about the emotional part of the market, because mathematically, sometimes you don't understand what is happening, and it's the fear factor. Trump says something and everything crashes. He says something else and everything goes up.
And the challenge is that it's the way families invest. Because the thing is that, the greatest example of what you just said is back in the 80s, the 1980s, 1990s, there was a hedge fund called a mutual fund called Magellan, run by Peter Lynch, one of the great money managers. Okay. And I saw a study. I forgot his exact numbers. Okay. You can end up checking, but he did something like 19% a year on average for more than a decade.
Wow.
Right? Incredible. The study showed Now, this was long before there was, index funds and all of that. So the only place, if you wanted a really big thing, would be in one of these large cap funds. And he ran the biggest one of them all. There was a study done for those 12 or 13 years that he ran the study that said, how did the retail investors do? The ones that would invest in motion, not the pension plans or, the institutions, but how did the individual people do? Remember, they're averaging 19% a year. The average investor made less than 1%. And it's exactly what you talked about. It was, you can end up actually seeing these conversations around the dining room table. Honey, what do you think we should do? Well, let's invest. Well, so, the family next door is doing so well. Yeah, but I'm afraid. And so they said, well, let's wait till next month. I just want to see one more month do well. And the next one, they wait and then finally say, you know what? It's going up. We're missing so much. Then we go to FOMO, right? We call it fear of missing out. Okay. And so they said, okay, let's get in. And then it goes up maybe 1 or 2 months, and then it starts to come down. And now they're like, oh my God, what are we doing? Okay, we're starting to lose money. Oh, but the family next door, they held on and it went down and it came back up. But let's give it another month. And then it goes down again. Then it goes down again. And then they're like, oh my God, we're losing too much. We have to get out now. Mm-hmm. And so from the emotional point of view, realize that we are hardwired to try to protect ourselves against risk and try to make as much money as possible. And the average person gets in at the top or close to it, and they get out at the bottom because they have too much fear.
It reminds me of a story of a teacher of mine that once told us, okay, this is my lesson. I was back then I was in Tulane, and this is the lesson. So here's a trick to finance. This is the only thing you need to know. Buy low, sell high. So that's it. You can go home. Buy low, sell high. The problem with that is for the next month or two, we're going to be training how to know when it's low and how to know where it's high. So that's, but it I love this concept of behavioral economics, because that's the thing is like in a cold conversation when you don't have any skin on the game, well, yeah, that's a good idea. And everybody, it's a futurologist of the past. Oh, I should have gotten Bitcoin back then when it was, it doesn't work like that. But the details, the nuances, you mentioned something that I just want to call the attention to, which is the emotional retail investor that wants to get in, and it's cheaper to open your Charles Schwab account and try to do it yourself, towards a professional investor, towards a professional manager that has no feelings, that has a method in which he believes, and in your case, you know what you're doing because you've lost money in more ways that they haven't. If it got
Sorry.
But no, that's the value that it brings to this. That's why we are trying to convey the message to teach people about funds, because that experience is worth a lot.
It's worth a huge amount. There are two really important points I want to make here. The first one, to talk about the emotional portion of it. About 25 years ago or so, the University of Tel Aviv did a study on the intensity of the emotion of making $100,000 versus losing $100,000. In today's terms, that's almost $250,000. And obviously, we all know that losing that $250,000 is a lot more painful than making it feels good. Mm-hmm. What I was surprised about is that the level of intensity was nearly 10 times greater in losing the money than making the money. Right? A huge thing. And when you think about that, is the average investor, okay, who doesn't have the experience and doesn't know, I have a discipline, I'm going to have these rules, this is the way it's, and I'm going to stay very focused, and I'm going to stay with the set of rules that we end up trading with. The other big challenge that I end up seeing, the point that you entered, in the US, because of the, I'm going to call it the leverage and the risk in a lot of different products, our government tries to end up saying, oh, you can't sell this to ordinary investors. And so they'll have to end up having a certain amount of sophistication. And the challenge is that we've accepted mediocrity. You talked about Charles Schwab and they'll come in and they'll say, well, we're going to try for this solid 6% a year. And it was funny. I had a client whose wife wanted to do this at the beginning of this year, and they're down a fair bit of money. But what they do is they use these products that they say are safer, and it just feeds into the machine where they the big institutions, make a ton of money. That's not where our opportunity is. Our opportunity is to know where those big institutions are and what they're doing. I use this analogy. Those big financial institutions are like elephants. Well, elephants leave footprints in the sand when they walk. Mm-hmm. And as smart investors, if we can see where those footprints and where they're going, it's very easy for us to be nimble enough with our size, because I don't have to move trillions and trillions of dollars like they do. Mm-hmm. And so that's where you end up learning through a lot of losses and a lot of experiences how to do that, because I've been stepped on the elephant a few times.
No, and the discipline, you mentioned the discipline. But I would like to enter into the regulatory part of it, if you don't mind, because our capital markets, they're really small and illiquid. And the legal framework that you need to why is it safe to invest in a fund from the legal perspective? Because I would love to have this discussion.
Okay. In order to start a fund in the U.S., we think about them in two different flavors. One for U.S. investors and another one for investors outside. Now, I'm going to start here because what I talk about inside of the U.S., most of it is going to end up applying to international investors. We end up having a certain set of rules that we have to end up going through. The SEC, or the CFTC, in my case, because I'm trading gold, it stands for the Commodities Futures Trading Commission, right? CFTC. They'll have these set of rules that I have to end up documenting what we do, how we do it. Now, it does not mean that they're going to guarantee that you won't lose money. All it says is that, hey, you've taken all of the steps. I know even though you don't have a lot of regulation, you still have to do the KYC, right? The know your customer and the anti-money laundering, rules. We have all of those, but then we have a lot more that we have to end up going through. There are going to be all kinds of filings that we have to do. Now, the big thing is that I'm going to go through the classification of smaller funds and larger funds. The larger funds are very difficult. And the reason why they're very difficult to do is that they need hundreds of millions of dollars to get them going. And their cost and their infrastructure costs them a huge amount of money. Also, they're not going to end up doing this unless they can end up attracting, hundreds of millions or billions of dollars into that. The smaller funds that might only do 20, 50, $100 million or less, we have less regulation. And the less regulation means that I can end up running certain strategies. Like, for example, the strategies that we run in both of our funds would not be allowed to be run into the bigger funds because of how strict their regulations are. And so basically, you're going into a gunfight with, not even a knife. I mean, it's very, very difficult. And what is challenging is that some of those big financial institutions, they'll run those same trades, but with their own money, not with their investors' money. Mm-hmm. And Ronald Reagan once said, I forgot what the number, but the 11th or the 9th scariest words in the English language are, I'm from the government and I'm here to help.
That's scary. Sí, es como cuando la SAT te manda a decir feliz cumpleaños a las 4 de la mañana. Yeah, you see, in our government, the tax agency are the first one to wish you a happy birthday, 4 o'clock in the morning.
So what happened?
Well, we have to go. Time's over. So thank you, Jim. Thank you for being here. I look forward to watching you on stage. And thank you for all your knowledge.
My friend.
We are glad to have you and your lovely wife here. And please come back.
Thank you so much.
We'll be waiting for you guys.
Y a todos ustedes, los vemos en el siguiente podcast de Chasing Alpha.